Hello and welcome to Live Wire Markets. My name is Chris Conway. Today I am sitting down with George Toubia. George is the Chief Investment Officer at Westpac Private Bank, and today we're going to be talking about the inefficiencies that he is finding in today's markets. George, welcome.
Thank you. Lovely to be with you, Chris.
George, in doing some research for today's conversation, I noticed that one thing that you've said in the past is that you love investing in inefficiencies. Can you just explain what that means for the audience, please?
The world of investing is not straightforward. And one of the major impacts of data, speed of information, ease of access of information, minute by minute being accessible to us is that capital is moving very quickly towards suddenly understood and popular opportunities. That in itself is a two-edged sword. One, it's an excellent acknowledgement that the opportunity you're pursuing is good, you'd hope. And second, the scale of it can really deteriorate the quality of the opportunity with time. So we are, as students of looking after our clients in a thoughtful manner, we are constantly thinking about opportunities that are exhibiting the following attributes. Either sit in market segments that are ignored by broad participants, yet have some strong positive structural drivers to them, okay? Or looking at market segments where there is a complete misunderstanding of the underlying opportunity and it's highly overlooked. So when we think about market structure or improper understanding of the opportunity, those two, if we can really identify them as early as possible, but in a very thoughtful manner, I think it gives us enough room to help our clients benefit from that, where the quality of that risk reward is really strong before it becomes understood.
George, what are one or two of the biggest inefficiencies that you see as it stands today?
There's plenty, to be honest with you. So first of all, market structure, in my mind, across the world is the biggest source of inefficiency. So I'll give you an example. In the world of private markets, in the world of supporting private businesses through the lens of private equity, we have always centered our focus on growth opportunities around small and medium-sized businesses. Now, those businesses, irrespective of the country, they generally represent 1/3 of the economy. Very powerful. But what really defines them is these are businesses that have an enterprise value maybe less than 1 billion. Okay? They are hard to find. They're not organized like a large company. But they have a very strong thesis for their customers. Yet, because of their small size, they generally are not the focus of large private equity investors. So quite often, if you have the tenacity, the discipline, and the patience to go and find those companies, okay, quite often you can find really high quality organic growth in businesses that don't have a lot of leverage, that are highly profitable and can do more, okay, for their customers. But most importantly, acquire them or be part of their journey at a valuation that is very reasonable and not using financial engineering as a way to create the outcomes. So that's an example of market structure where we constantly find opportunities because of the fragmentation, the small sizes of those markets, and the lack of attention of large capital.
George, you've spoken about 2024 and 2025 being a watershed moment for intelligent debt capital. Can you just unpack that for us a little bit, please?
Yeah, of course. So we have been early advocates of the alternative provider of capital opportunity, which is very well understood by the markets today. We've been early advocates since 2013. So we launched that thematic for the benefit of our clients. So we've been on this journey for about 10 years now. But what is really defining this watershed moment now, from our point of view, is that there's never been a moment in time, from my point of view, where these regulatory hurdles that we've been living with for the last 10 years not only are present, but are likely to get more intense. Regulation in the US through the Basel III endgame, which is yet to be implemented, is going to be more strict on the banks in America, when ironically, most of the major banks in America are flush with capital. Okay, so here's the irony. Regulation is going to become even tougher. Now, on the back of moving from a regime of abundant liquidity to tighter liquidity, the number of lenders in America has declined by 30% since 2022, okay, then you have an increasing number of the banking system community in the US, such as the small banks, will be busy dealing with their existing books for obvious reasons, okay? And then add on top of that, there is a significant amount of debt in the commercial market that needs to be refinanced. So between 24 and 2025, there's going to be $1.5 trillion of loans that need to be refinanced. Okay, so when you think about the intersection of those variables, there's never been a period in our mind where the demands and the important role of alternative lending done correctly been as productive as the regime that we're in today.
George, just unpack for me a little bit there the importance of it being done properly. So it's a big opportunity. You've talked about the size and scale of it, and that it is not a saturated market like some of the other areas of private credit at the moment. So why is it so important that it be done correctly, and what does that look like, do you think?
Lending may come across as an easy business.
Yeah, it's not.
Lending is not an easy business, and whoever says lending is an easy business probably has not done that for a long period of time. So for us, it's important not to be enticed by generic opportunity and accept loose covenants and loose protective features that come with that lending opportunity, just simply because the environment today is offering you close to a double-digit yield on that opportunity. So for us, when we think about lending, we think about it's important to be targeted in a specific market structure. Secondly, it has to be done in the right structure. And thirdly, it has to have the right skills. So if I work backwards, doing it with the right skills, we look for the right teams that have been cycle tested, have done lending over multiple crises, and they know how not straightforward it is sometimes to get paid back and refinanced, okay? And we only look for organizations that can roll their sleeves up and take control of the underlying asset should something go wrong. It's easy to lend, it's not easy to get it back. So we need those extra skills just in case something goes wrong with a company or a real estate project. You need those attributes. The structure has to be right, because lending in those private settings is private, and liquidity mismatches are not correct. And giving people the false sense of comfort that they have intermittent liquidity is not good, especially when people need it, because that's when times are very demanding in nature. Getting the structure right is very important, and going back to what part of the market is important for us, because once again, we think small mid-markets represent areas where the quality of the opportunity is very robust. You can sit with a company face-to-face bilaterally, okay, and negotiate the right risk-reward with the right covenants. If you are in the larger segment of the markets, including private credit markets, there will be a lot of competition, and not only the upside will deteriorate, but also the features, the protective aspects that come with it will deteriorate. So that's why we think it needs to be done through the right lens to benefit from it through cycles in a sustainable way.
George, let's talk about how you're taking advantage of the opportunity, whether it be in Australia or internationally. How are you actually locking this opportunity down?
For us, being a private bank based out of Australia and understanding the importance of our clients' need of familiarity and comfort zone with markets, clearly our theme has got foundations in Australia. And we're doing that in multiple market segments. We've been doing that in real estate for about 10 years, and we moved into the world of small mid-market corporates about a couple of years ago, where there's extreme inefficiencies, where suddenly, if one of the major banks is unable to lend a customer for regulatory reasons, there are no obvious alternatives for that, okay? But in the US, we've been active in that space for about 8 years, because the US has got a depth that is disproportionately much larger than any other market, but also there is a strong legal system that is tested every day in terms of enforceability, of security and collateral. And whilst the market is so large, it's usually focused on the larger opportunity set, so it leaves abundance of inefficiencies in those markets. Europe for us is not that critical at this stage in terms of opportunity, But I have to say, in places like Southeast Asia, where credit is still scarce in general, we talk about our banking system, where net interest margins are 1.7 and 1.8. Net interest margins in some parts of Southeast Asia in the traditional banking sector are 3 and 3.5. It talks about there is a complete disconnect between the demand for credit due to thriving demographics and the supply of it. There the opportunity is very strong, but we are alert that the enforcement of structure and security and entitlement is not straightforward in some markets where the rule of law is not fully tested for the benefit of the lender. So we park that until that regime becomes a little bit better. But for now, we're very busy in the US and Australia, and we think that opportunity in that specific market segment has got durability.
George, thanks so much for sitting down with Flavour.
Pleasure to see you. Thank you.
If you enjoyed that interview as much as I did, make sure to give it a like, and don't forget to follow our YouTube channel because we're adding lots of great content every single week.